There is nothing worse than crappy investment advice online. Most investing advice today falls into two extremes: set it and forget it, or chase the hot tips and the hype. The problem is, neither of these approaches actually build real wealth. The real damage happens quietly, inside portfolios that look safe on the surface. As an institutional bond trader for nearly a decade, managing hundreds of millions of dollars of risk, and now as a financial advisor to wealthy individuals, I have a ton to share on this topic. Today, I'm going to walk you through the 3 silent killers that destroy long-term compounding that I personally see in my practice. And don't worry, I'm going to show you how to fix it. All right, so come with me back to the studio. All right, for the first silent killer of your portfolio, it's ignoring your 401k. Now, I have a lot of clients that walk into my office. They haven't checked their 401k in 10, 20 years. They've never worked with a professional before. And what we do is, when we dust the cobwebs off of the statements or log into their portal, is we find something that was built for a 20-year-old or something that was built for nobody at all. So the everyman portfolios. Once you're inside of these things, you're going to see a few options. You're going to see a target date option, likely in modern portfolios, or you'll see these set it and forget it, the growth and the balanced option, right? There might be something called conservative in there as well. These 401ks, right? This is something you set up during onboarding in under 30 minutes. You never looked at again. So that quick decision, if you don't look at it, becomes a multi-decade mistake. And I see it all the time. On the top of my hit list, the usual suspects, number 1 is definitely target date funds. And then a close second are these just preset portfolios, the growth, the balanced, or the conservative. Let's talk about target date funds first. So an example would be the Vanguard Target Date Fund. This is very popular, 2040 fund, okay? This means that you're set to retire in 2040. This is VForks. VForks dropped 17% in 2022, okay? Why? Because VForks is still built on a 60-40-ish stocks bonds split, okay? But the bond portion isn't durable. That means that it's built with bond funds. So in this case, AGG, VB, TLX, this fell 13% in 2022. So the hedge completely failed. So these target date funds end up giving you a brand name promise, a target date. I'm retiring in 2040, in 2050, whatever the date is, but they're built on really flimsy structures that really aren't helping you. There's a glide path built into this. So over time, it's supposed to adjust from equity down to bonds. But of course, in a regime like we're in right now, you don't want to be piling on to the long end of the bond curve. This is just where you're exposing yourself to a ton of interest rate risk. So what to do instead? Stop relying on these fun names and actually crack open the darn thing and look under the hood. What is it? Is it a stock bond mix? And what is the bond safety, I put in quotes, portion? What is actually being held? Because once you look into these things, you find out that there's no magic whatsoever. You find that they're just really kind of lazy allocations that are built for everybody, meaning they're built for nobody. One of the biggest suggestions I can make here is build your personal glide path. So something that evolves with you, not that just is mandated by the Vanguard Target Date Fund. So actually think about how much risk you can weather right now and adjust as you get older. You really should be taking less risk as you get older because of timing risk. This means, sure, stocks always go up if you have 100 years. If you have 10 years, 20 years to retirement, your timeline is not infinite. It is very finite, and those sequence of returns matter a heck of a lot because withdrawing funds from your 401k in retirement in a down market has a very different return curve and a longevity curve, I should say, than retiring into a bull market. Of course, you don't get to decide what market you retire into. So thinking about these growth and balance presets, I do want to talk about these really quickly. Growth just usually means 80-20. So 80% stocks and 20% bonds, and it usually has 90% overlap in some S&P style large cap ETFs. Balanced is back to 60-40, so probably where you are in some target date fund if you're in your 40s. This thing fell 16% in 2022, the balanced funds. So you get all the risk and you get very little cushion in a balanced fund. So in terms of the presets, diversify by strategy, not just by fund name. Use bond alternatives if you can. You're going to have a lot more flexibility if this is an old 401k. If you're under 59 and a half, if you're older than 59 and a half, you have the most flexibility. You can do whatever you'd like. An old 401k meaning you left your job, so you can kind of do what you want with it, roll it into an IRA. In bond alternative land, we're talking structured notes, fixed index annuities, cash-like instruments, cash or money markets. This is actually hedge material, not, long duration bond funds. Also, build in non-correlated sleeves. What this means is not more equities in disguise. Think about REITs. Think about gold and commodities in small portions, not as your durable hedge. Again, use it for risk, not for hedging. Number two, not all ETFs are created equally. Now, I want to show you two broad-based ETFs. One's VU and one is called ARK, and just show you how different these ones performed over time, because you've obviously heard buy the low-cost ETFs. Vanguard, this is the S&P 500, low cost, liquid, and transparent. But you might have something like ARK in your portfolio. High fee, high turnover, down 70% from its peak. Both are ETFs. One builds wealth, one destroys it. So just because it's an ETF doesn't mean it is a broad chunk of the market, and it doesn't mean it's the right broad chunk of the market for you. This brings me into a little narrow focus. We're going to call it overlap. So if you own VU, QQQ, VUG, dividend ETFs, they all own Apple, Microsoft, and NVIDIA. So what does that mean? That means the top 10 holdings of QQQ and VUG are 90% identical. In this scenario, just owning a bunch of different tickers, it's not diversification, it's just branding. So here's what we do instead with my clients. We audit your ETF overlap. A free tool that you can use is Morningstar. You can manually just go in there and see exactly what the holdings are. You can also use ETF Research Center. So there's tools that you can use to make sure you're not just buying more, of the same thing stacked on top of each other. For your core ETF structure, boring is good. VU, VT, SCHD, which is the Schwab Broad Market, or AVGE. The most important thing to note here is to surround yourself with non-overlapping core. This is how you pick a different piece of the puzzle and you don't just stack the same piece on top of each other. Section number 3, I mentioned this a little bit in the beginning of the episode, but you might be ignoring timing risk. I know I have a lot of clients that walk into my office that don't quite seem to grasp this concept, so I do want to share it with you. I want to show you two portfolios that have the same average return, but they have different sequences. One might earn a little bit more in the front end, while the other might have sort of a slow start and then pick back up as we go through time. So everyone says market averages 8% a year, right? Sequence matters a heck of a lot. So losses early, this will dramatically lower the total value over time, especially if you're withdrawing, you're rebalancing, which you should, or finally, you're panicking and selling, or you're just saying, get me out of stocks. This whole thing is called sequence of returns risk, and it crushes real-world portfolios, especially in retirement. So I don't want to use 2022 again, but this is where a lot of these correlations started to break, and they're reflected in 2025 price action. Stocks, bonds, and ETFs, they all moved together in 2022. And when everything correlates, there's nothing to cushion the blow. This means that timing risk was accentuated if you were unlucky enough to retire in 2022. So here is what you do instead. You build a volatility buffer. You can do this with short-term treasuries. You can do this with defensive alternatives. You could do it with FIAs. But the most important thing is to allocate risk dynamically, not just stick with your 80-20. This is so important because at this point in your life, you are not willing to weather the storm indefinitely. You are going to start drawing down in the next 10 years. So your sequence starts to really, really matter. So the most important thing to note here is that wealth isn't created by chasing returns. It's built by compounding through the chaos. That means periods of uncertainty like we are in right now. If you're still scratching your head, that is exactly why I built the Bulletproof portfolio. It helps you fix the hidden drags, plug the leaks, and build something that lasts. Also, it's priced less than what most people lose in a single year due to poor ETF allocations and hidden fees. I'll drop the link in the description now so you can take a look if you'd like. But to leave you with a single message, the biggest flex in investing isn't returns. It's surviving when others don't. Thanks for joining. I'll see you in the next episode.